Dave, thanks for joining our quarterly webinar. As I reported earlier, we've again experienced an interesting 3 months in the economy and the markets.
Yeah, thanks, Joe. I always look forward to sharing my thoughts with our participants and institutional clients.
I'm sure our viewers would like an update on the banking crisis that arose in March, but let's start out by hearing your thoughts on the topic that continues to dominate the broader economic narrative, and that's inflation. How effective do you think the Federal Reserve has been at bringing down inflation?
Yeah, you're right, Joe. Economists and everyday consumers continue to worry about inflation. In addition, talk of recession persists, and we can discuss that later in this segment of the webinar. But before I respond to your question about the efficacy of the Fed's interest rate policy, let's take a look at the inflation numbers. I always like to begin my inflation report with a reminder to our viewers about the components that make up the Consumer Price Index, which most of us recognized as a proxy for inflation in the United States. As you can see in this first chart, housing, food, transportation together account for 3/4 of the CPI. This next chart shows the path of year-over-year increases in the CPI over the last 2+ years. Inflation peaked at an annual rate of 9% in June of last year. The federal government reported that March inflation was just 5%, which was a meaningful decline in the year-over-year numbers compared to February. It's been nearly 2 years since the annual inflation rate for the trailing 12 months was this low. So that's certainly a positive sign, Joe. However, we need to dive into the data to understand if we can feel confident that inflation will continue its descent. So on this next slide, we look at the inflation rates for those 3 categories that comprise 75% of the CPI. I'll start with food and transportation and then come back to shelter. After peaking at 11.2% year over year, food inflation over the past year was 8.5%. That's higher than we would all like, but the trend is positive. Interestingly, I read that egg prices declined last month by the most in nearly 40 years. Transportation prices are down over the past year, largely attributable to lower prices for gasoline, which is down 17%, and used car prices, which are down 11% over the past year. I should note, though, that transportation services such as auto maintenance, auto insurance, and airlines are all up in mid-teens. While the overall rate of inflation continues to ratchet lower, what concerns me, Joe, is the extent to which shelter inflation has remained elevated. To the extent that shelter accounts for nearly half of CPI, it's hard for me to envision that inflation rates will reach the Fed's preferred 2 to 3% range by the end of this year. Now, I have 2 more slides that dig deeper into shelter inflation, but I do want to mention the chart on the right that looks at consumer inflation expectations for the next year, which are continuing to decline. Each month, the University of Michigan conducts a comprehensive consumer sentiment survey, which includes a question regarding about future inflation. Consumers are feeling more optimistic as they expect prices to expand 3.6% over the next year, though that's still higher than what the Fed is targeting.
Before you move on, Dave, I know you've seen that the Case-Shiller U.S. National Home Price Index has declined now for 7 consecutive months. We've seen reports that rents are declining. Don't you think that we're close to seeing a turnaround in shelter price increases?
Yeah, those are all good points, Joe. Indeed, housing prices are down 4.3% according to the Case-Shiller Index. And as you accurately state, reports of actual changes in apartment rents show that average monthly rents have been declining for about the last 6 months. So let's first look at housing affordability. Although you're correct that housing prices have declined, we must not forget that interest rates for 30-year mortgages have more than doubled. So even after you consider the decline in housing prices, housing affordability, as you can see in the chart on the left, is no better than it was immediately prior to the bursting of the housing bubble and the Great Recession some 15 years ago. And on this chart, the higher the index number, the less affordable or the more affordable is housing, and the lower the number, the less affordable is housing. Now, while the illustration on the right may not have direct bearing on housing affordability, I thought it was interesting and wanted to share this with our viewers. In January, every housing market in the eastern part of the U.S. except for Austin, Texas, saw year-over-year increases in housing prices, while Austin and every market in the West have seen declines in housing prices. Notable are the double and near double-digit increases in Florida and the double-digit decreases in California. So now, Joe, let's take a look at rents. I saw a version of this next chart recently from a company that surveys apartment owners. They estimate that average rental rates have reversed their downward trend and are rising again. The actual data could prove otherwise, but I'm not sure we can definitively say that rent costs will continue to decline. All that said, I don't believe that we are going to have 8% plus shelter inflation for the remainder of 2023. But then again, I am skeptical that the rate of inflation for housing will see a meaningful drop anytime soon, absent a severe economic downturn. So finally, Joe, let's get to your initial question regarding how effective the Federal Reserve's interest rate policy has been in fighting inflation. First, I would be remiss if I did not acknowledge that the Fed does not consider the Consumer Price Index as the best proxy for inflation. Rather, the Fed prefers to focus on the core personal consumption expenditures price index as its preferred gauge of inflation. This next chart looks at the recent history of the Fed's preferred inflation proxy. And as you can see, inflation as defined by the Fed has hovered in the 4.5% to 5.5% range for nearly 18 months. Core PCE inflation excludes the more volatile food and energy categories. During the recent bout of inflation, it's been lower than CPI inflation. However, we haven't seen meaningful declines compared to those declines that we've seen for CPI. And the Fed has clearly stated that the current level is not acceptable and it must continue to act to get inflation closer to its 2% target. Hence, up until now, has the Fed's interest rate action effectively lowered inflation? I think that the data on this chart would likely lead one to believe that there is still more work to do.
So why do you think that is, Dave? Why hasn't their aggressive interest rate policy been effective in bringing down inflation?
I guess, Joe, the best explanation I can provide is that the economy just refuses to roll over. So let's look at this next slide. Regular viewers know that I like to refer to the Atlanta Federal Reserve's forecast for economic growth. Presently, the Atlanta Fed is forecasting 2.2% growth in the first quarter. That's pretty good given all the pessimism that we saw at the beginning of 2023. What's more, as you can see on the right side of the chart, economists are continuing to forecast anemic growth for the full year.
So why is that, Dave? Why does the Atlanta Fed think that the economy performed much better than economists originally expected?
Because jobs remain plentiful and unemployment is low. I could show a lot of charts demonstrating the resilience of the job market in the face of an adverse interest rate environment. However, I'll display just one. This next chart looks at the rate of unemployment claims as a percent of the total civilian labor force. Stated differently, it looks at 55 years of history of people filing unemployment claims. The ratio of terminated workers is near historic lows, with only 15 of every 10,000 workers having lost their job in the prior week. When people remain employed, their spending contributes to a vibrant economy, but it also contributes to elevated pricing. Hence, it does not appear that the Fed's work is done.
But is this the final chapter, Dave? Do you think that there is a recession on the horizon?
Candidly, yes, I do, Joe. I'm a bit concerned that we're experiencing in the final chapter before the onset of a recession. Of all the charts I'm showing you today, this next one I think is the most interesting and the most sobering. What we're seeing here is over 60 years of history of the Conference Board's leading economic index. The Conference Board analyzes 10 different data series covering a broad swath of the economy to calculate a composite index that reflects changes in the data. This chart looks at the year-over-year change in the index. Superimposed, as represented by the gray bars, are the periods when the U.S. economy was in recession. We've had 8 recessions over the last 50 years, and in every case, the economy entered recession at or soon after the year-over-year change in the index went negative. 9 months ago, the year-over-year change went negative. Hence, if history repeats, it certainly seems that we are overdue for a recession.
So, Dave, that's not very comforting news. It seems that if you believe a recession is imminent, then you must also believe that the stock market is in for a rude awakening.
Not necessarily, Joe. First, our viewers should not assume that they are among the first to see this information. Markets are incredibly efficient, and you would be correct to assume that this information has been widely disseminated and already reflected in stock prices. It's fair to say that the market is currently expecting a recession. What remains to be seen is how severe the anticipated recession might be.
So then what do you think, Dave? How severe do you think the recession might be?
I hesitate to guess, Joe. If I had to, I would align with those who believe that we will experience a mild recession before the year is out. It may have already begun. I worry about increased consumer debt levels, and I worry about the impact of student loan repayments when they resume later this year. As you and our viewers know, however, I am an optimist. I believe that the world economy will continue along a path of modest and sustainable growth. I accept that there will be hiccups along the way, but I do believe in human resilience and the ability to overcome the unknown challenges that we will continue to confront.
Fair enough. Let's move on and talk about the crisis du jour, the banking turmoil that began with the collapse of Silicon Valley Bank and Signature Bank, compounded by the implosion of Swiss banking giant Credit Suisse. You and I posted a video conversation several weeks ago where we talked about the implications for markets and the economy. Is there anything that you'd like to add based on what you've observed in the most recent weeks?
It seems as though at this point, Joe, the fallout from the recent crisis has been contained. That said, I think it's way too early for anyone to assume that another shoe is not about to drop. Small, regional, and community banks have certainly been felt the most significant impact. The next chart looks at 3 years of monthly history of deposits into and out of the small regional banks. Unsurprisingly, we saw a spike in deposits at the onset of the pandemic when people were locked up and were unable to participate to any significant degree in the economy. Subsequently, deposits for the most part continued to flow into banks, with some months experiencing outflows as consumers found better interest rates in the bond market. But take a look at the outflows in March. It's fair to say that the bulk of these outflows are directly attributable to concerns regarding the viability of these small banks. Again, it is too early to say whether this trend will continue, but it certainly bears watching.
Thanks, Dave. That's interesting information. And before we move on, let me ask, Do you think that this recent banking crisis serves as the proverbial canary in the coal mine? Do you see another crisis on the horizon?
Another good, tough question, Joe. I guess I'll defer to the experts at JP Morgan. A couple of weekends ago, I listened to a podcast with JP Morgan's investment strategist, Dr. David Kelly, and an analyst on their fixed income team. Dr. Kelly asked her a similar question, and her answer certainly resonated with me. She talked about two issues that will most certainly affect the commercial real estate market. The first and the most obvious is the work at home trend, which is affecting the demand for office space. But the second and more insidious concern is the expected tsunami of refinancing of commercial real estate loans. Trillions of dollars of loans must be refinanced in the near term. And given the spike in interest rates, real estate owners will most certainly feel the pressure, and the possibility of widespread defaults is real. While we don't have time during this webinar to explore this in more detail, rest assured that it is something Wespath will be paying close attention to.
Gee, thanks for that, Dave. Something else for us to worry about.
That's the nature of our business, Joe. We're always worrying about something, and our clients and stakeholders expect nothing less.
That's true. Before we close, Dave, is there anything else that you'd like to cover?
Sure, Joe. As is my custom on our webinar, I try to touch on international issues and corporate profitability. Internationally, the economic situation isn't much different than the U.S. Manufacturing is in the doldrums, but the service sector is reasonably strong. Continued inflation remains an issue, compounded by geopolitical concerns led by the ongoing war in Ukraine. Economies in the developing world don't seem to be suffering, though, as you showed earlier, you wouldn't know it by looking at the performance of emerging market stocks. Wespath remains constructive on international markets, and I would encourage viewers to take a look at my recent blog post on why Wespath invests in international securities. Now, regarding corporate profits, this last slide shows analyst predictions for the direction of corporate earnings in 2023 and 2024. Analysts are decidedly more pessimistic today compared to 3 months ago. They see profits contracting for the first 6 months of this year, modest growth in the third quarter, and double-digit gains in the fourth quarter and into 2024. But again, all of this news is known by the market and reflected in stock prices.
Well, thanks for your insights, Dave. The markets are off to a good start in 2023, and we should certainly expect more interesting news in coming months.
Thanks, Joe.